Welcome to CFO Chat. This is a platform where we host the chief financial officers of companies as and when they release results, and we're privileged to have Lawrence Kimathi of KCB Group. Welcome on set.
Thank you.
I should say congratulations. NBK is now back to profitability. I was quite impressed by that. But I should then ask, looking at the NBK numbers, in a loan book of about 55 billion, just about half is actually in NPL capacity. What do you make of this?
Yeah, when we acquired NBK, actually it was half that was in non-performing. The figures come down marginally, sitting at about just under 40%. Of it is NPL. Our work, remember, when one of our pillars when we acquired NBK was to go after that bad book, because we believe that we had the balance sheet, the muscle, the network to be able to recover at least half of that, and you know that would have come back into profitability. So 2020 happened, not the perfect environment to be doing recoveries. So the strategy will continue into 2021, and we believe we'll make some good headway.
And still on NBK, looking at the prudential requirements, from a core capital standpoint, it looks to me like it's still skating on thin ice. Is there any plan around this going forward?
Yeah, absolutely. So we will capitalize NBK. We've got a plan that we approved back in 2019. Before the end of this quarter, we'll be putting in some debt, about 3 billion shillings in debt, tier 2 facility for them. And then we will, going back to the conversation about recoveries, because that bad book also is eating into capital. And there is a plan, a strategy to get the next 6 months aggressive recoveries. Once, we evaluate that come September, we'll take a decision on whether we do need to recapitalize, put in more capital, or whether NBK will be generating enough capital on its own.
One of the things that surprised me at the group level was when I looked at your costs for the year and the review, and I thought KCB would have been a lot more aggressive, because I think I saw a double-digit increase in operating expenses. How did we arrive at this?
Yeah, well, when you look at the face of the accounts, it does look a bit baffling that our costs grew by 12%. However, remember we acquired NBK in Q4 of 2019, so we've got an annualized 2020 comparison versus only one quarter for the purposes of NBK. If you strip out NBK and do a like-for-like comparison on cost, our costs came down by 3% in a year where regional inflation was sitting at about 6%.
And still on the issue of the prudential requirements, then the bank has proposed a dividend payout. Many of us would think it's a bit surprising in light of the environment we are in operating, especially given the conversation you're having about NBK. You don't seem to be bothered by that.
Well, I don't think I'll say bothered is a word to use in this particular case. If you recall, our last dividend we paid was 3.5 shillings per share. We've proposed a 1 shilling for the year. And when you look at our capital buffers, we have our own. There's a regulatory minimum. Then we put our own upside premium just to ensure that we are able to to deal with any emergencies. And even on that internal minimum, we are still sitting pretty in terms of the buffer level. So I think it's in a year like 2020, we've got shareholders who depend on dividends as a source of income, and I think it's only right for us to distribute, even if it's less than a third of what we did the previous year.
Quite generous for your shareholders, I must say. Disaggregating your income, I think I saw a 19 or 20% dip in non-branch revenue. And in an environment where increasingly your revenue is coming from outside the branches, many of those who look at your numbers, keenly, be it shareholders or analysts, would be a bit worried by this. What's 2021 looking like?
So two things drove that performance of non-branch revenue going down. One is, you recall, we had all transactions, mobile transactions, bank to mobile wallet transfer fees were above 1,000 shillings was zero rated. Basically, we gave a waiver to support the economy. The second thing was our KCB M-Pesa proposition, which is a lending proposition on mobile. That also, we made a deliberate decision to reduce the disbursements in the year, given the situation we found ourselves. We do risk buckets, so we look at all our customers and put them in various risk buckets, and the information analysis, advanced analytics we did basically informed us that we needed to close those, make it tighter on the risk buckets. Come 2021, we see an improvement on that proposition, the KCB M-Pesa. I think we are getting to a point where we can, start broadening that the buckets that we address. On the conversation about the fees for transfer money from bank to mobile wallet, our conversation is still happening with the regulator. The waiver has been extended; it's still continuing into this year, but we believe there's opportunity in there as we continue discussing with the regulator.
I see. Yeah. And looking at your larger income profile, I think I saw a bit of heavy lifting came from government securities, and just this morning the CBK has given guidelines in terms of loan restructuring and going forward. When you look into 2021, do you still anticipate that we'll essentially be playing, if I could call it, in the rate cap regime where we saw government securities really driving the agenda?
Well, what tends to happen is you raise your deposits, then you look at what do you want to utilize those deposits for. Do you want to disburse them in way of loans? Having looked at the risk profile in the market, and any excess goes to government paper. And even on the government paper, you take opportunistic positions in there. So you're right. 2020, given the situation, subdued lending, excess liquidity went into government paper. I think our interest income out of government securities grew by 65%. That was a massive increase because we took opportunities. This year, as the economy starts grinding back, sector by sector, you see improvements. Then we expect that we will mirror that and start lending, growing our loan book. But it's one of those areas where we really don't know how it's going to pan out. I mean, we never expected such a massive third wave like we are going through at the moment. I mean, we could be going into a lockdown. It's a possibility given where the numbers are. Then if you go back into lockdown, you start looking at is this the right time to lend? Probably not. Be very choosy where you put your money. Might go into government paper. So we are playing with both strategies, evaluating the situation on a week by week basis.
Speaking about the risk profile out there, looking at the group numbers from an asset quality standpoint, I think the KCB group's NPL ratio now is at about 16%, flying above the industry average of about 14, if I got my math right. Some of us looking into the bank would say that's a very uncomfortable position to be at. Do you hold this assessment?
So we are actually at 14.7, just marginally above industry. It is a worry. We have not been above industry, I think, since I joined this bank over 6 years ago. So yes, so it is not a comfortable place to be. We have put in place strategies to ensure that our recovery process, our early alert process of helping the customers before they dip into non-performing. We have a special assets unit that looks at that. We have tightened our underwriting origination process. So there's a lot of work. It's not a silver bullet that solves this. It's a multi-prong approach that we look at. But yes, it is a concern, that number. We believe that this year it should start heading downwards.
One of the landmarks of last year was the Green Climate Fund accreditation. And many of us are just curious to understand what sort of pipeline are you looking at from a lending standpoint, and how this is going to boost your loan book?
We do actually already have a very good pipeline of green assets. Actually, one of the reasons why we managed to get the accreditation is when we were being assessed the assessors, understood that our balance sheet does carry a massive, I think, if I remember correctly, it's close to about 200 billion, if I'm not wrong, of shillings of green assets. And we believe this is, the future, energy sector, future for that sector. Hence the reason why we went for the accreditation. Also remember, this GCF augments the IFC facility, IFC syndicated facility that we raised, which one of the key primary on lending assets was also green energy, renewable energy.
One of the issues which I could call the elephant in the room as we speak is the fact that there isn't much clarity as to the risk pricing model operating in this market as we speak. And just like to understand from your perspective, what do you see as the way forward? Because to the best of our knowledge, there hasn't been much guidance from the market regulator as far as this is concerned.
So this conversation is actually still happening at industry level. It's been picked up by the Kenya Bankers Association. You're right. I think it's, from a priority point of view, not sure that it was a priority for 2020 in the environment we were in, and that was the first year of the repeal of interest rate cap. So I would say let this play out from a conversation that the industry is having with the regulator. I believe this should be something that will be very quickly resolved.
And finally, from a cost of risk standpoint, looking into your numbers, of course, the group level numbers look pretty good. But then there is the aspect of NBK which always comes up, and we're looking at this this aspect of it. How comfortable would you say you are?
Yeah, so we believe, remember, part of the big loan loss provision that we impacted our performance in 2020 is actually what we call COVID overlays. You're looking at accounts, different sectors, and making a decision from a forward-looking information point of view of when do you think these accounts will recover, if at all, and you take a decision today. Do I make a provision on this now or not? Because IFRS 9 is more about forward and not incurred, not what has happened, but more about anticipation. So on the basis of that, we believe that we've done a good forecasting in terms of our cost of risk for 2021. But as I said, the environment is still very fluid. We are not out of the woods yet. Countries in Europe have started going back into lockdown. We ourselves here, you can see wave 3. So it's one of those things that we monitor on almost a weekly basis. But we believe with the information that we currently have, we are comfortable with that forecast. But should it change, we'll be the first ones to give a revised view.
And that takes us to the close of our conversation with Lawrence Kimathi, the CFO at KCB Group. Stay tuned for our next episode when another company will be releasing their financials.